Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods. I'm not a professional investor. I don't work in the financial industry. This is an opinion channel about money. And today I want to talk to you about why I might sell Apple stock. All right, everybody, I am wearing my New York City finest shirt. I just got back from San Francisco, so I'm like all about America for this weekend. I don't know, I had a great time in San Francisco. It was wonderful, and the weather was half decent compared to Vancouver, but I'm happy to be home. I've been sitting down this morning, and I've been like madly just crushing out this crazy spreadsheet, as you guys like to see on this channel. And of course, as you guys can imagine, I get pretty engaged in talking to people about finances. So I'm talking to this guy and he asked me, he's like, are you like, how do you feel about selling Apple shares? And I'm like, well, I don't really trade a lot of Apple shares. I always trade the options on Apple. I'm pretty bullish on it. I like it in general. I have a good position in Google and Amazon. Those are good growth stocks for me. I don't have a position that's massive in Apple, but I mean, I'm not against Apple at all. I don't think we're going to see a huge crash, and I think we've got some upside value going forward for the next couple of years anyways, as long as they keep doing what they're doing. That's my personal feeling on that, and you guys have seen me talk about that before. Anyways, we got to chatting, and he let on to me that he has over $1 million in Apple shares, and that the Apple shares that he has actually are comprised of about 60% of the total portfolio value. Now, to me, I don't invest like that. You guys know I like to diversify way more. So I would never let my stock portfolio get that weighted to one single stock. But I started to think, like, what do you do in that case? Because obviously he's had these shares for a really long time, and he didn't pay very much money for them. So I've kind of come up with like a theoretical scenario based on a few kind of loose figures that I know about it. And I want to go through this with you guys because it's pretty interesting, the numbers and how they work out. We know that Apple today is trading right near its all-time highs at $216 a share. We know that a couple years ago it did a share split when it was $700. We had a 7-to-1 share split, and that dropped the value down to $100. Since then, we've seen that expansion. The stock has more than doubled in value, going from 100 to 216, and it is quite aggressively moving upwards. It's uptrending. So obviously not a bad position to be in, owning a lot of stock. But the biggest problem about owning a bunch of stock, and especially when you purchase it for low value, is that you're going to eventually have to pay the capital gains on it. So the capital gains become a huge part of the consideration. Of course, you got to pay tax on the dividends. You have to pay tax on the capital gains if you sell the stocks. So I decided I would just run a little scenario and see what the best outcome might be, or what we can kind of think it might do, because really we don't know what's going to go on with this stock. It could crash. It could go right back to $100. It could go, I mean, it's not going to do that, I don't think, but it could. There's always risks involved in any sort of trading like this. And that's why it's important to have diversification. Anyways, let's take a look at the chart. I'm going to show you. So I've calculated out this kind of fictitious price. I have no idea what he actually paid for it, but I know he's had over a 300% gain on it. I put in an average Apple price of $61.71, which is about a 350% return to the current price of $216. We've got Apple. I'm just saying theoretically 4,627 shares at 216. That gives the portfolio value about $1 million worth of Apple. And then I've thrown in here for good measure just a handful of dividend stocks. We're 600,000. So we've got a portfolio weighting of 62% Apple, 37.5% dividend stocks. And of course, Apple's dividend yield is 1.36%. The annual dividend yield from the basket of dividend stocks is around 7%. As you guys know, I always use this average return because it's really easy to get between that 6 and 10% dividend payout, and it's easy to collect the 7%. Based on those figures, the Apple stocks at 1 million at 1.36% are going to yield around $13,000 in dividends, and the dividend stocks will yield about $42,000 in dividends. Of course, Uncle Sam's got to get his cut, so we're going to put in a 22% capital gains dividend tax. They're usually about the same in most places, so I'm just using 22%. That might be a little bit higher. Of course, you got to contact your bank or your broker, your accountant, or look it up. Whatever state you're in, whatever province, there's going to be specific numbers to these. But for today's scenario, we're just using loose numbers, 22%, just to see where it goes. So the taxation amount on the $13,000 that we receive in dividends is $2,993. So the after-tax income for a year's period would be just over $10,000 on $1 million. Now, I actually think this is why this is the biggest reason I would want to sell Apple, because although it's a growth stock, $1 million that's generating $10,000, that's pretty bad. Like if you had $1 million in dividend stocks, you're generating $70,000. Now the difference between $10,000 and $70,000 in a year is a lot. I mean, most people, if they had $1 million portfolio, would be able to live off those generated dividends at a 7% yield. At 1.36%, $10,000 isn't enough for us to live on. So for most people anyways. So after tax income on this $600,000 at 7% is way greater, $32,000. So in the current scenario, after taxes, estimated a $1.6 million portfolio is yielding around 3.47%, and its after-tax income is around $43,000. I wanted to just run the scenario and say how many shares is appropriate to sell? Like, what if we sold 1,000, 2,000, 3,000, or 4,000 and just dropped it right down? So that's exactly what I'm going to do. Let's take a look at if we sold 1,000 shares at $216 each, a total transaction value of $216,000. Now, of course, you've got to pay the tax on that. So the tax is going to be $33,000, and the after-tax income is going to be $180,000. In this scenario, what I would do is I would take this $182,000 and I would plunk it straight into the dividend stocks. So that's exactly what I've done. I've taken the $600,000 that we had in this current situation and I've added the $182,000 after tax value into the dividend stocks. So now the portfolio weighting is a little bit different. Still not really great. You've got one stock, 50% of your net worth, but a little bit better. It's definitely driven up our overall percentage of the account, but it's also decreased the overall value. We've got less money now because we're short this $33,000 in taxes that we've just had to pay, but we've increased our annual dividend yield by $10,000. We've also increased the tax a little bit. Total at the end of the year, after tax income, after all is said and done, we've got about $17,000. Now this is in the first year. So we're rebalancing the portfolio, and we know that because we're having a higher yield, that's 4%, going forward we're going to see this growth over time. The question is, how long is it going to take? Now let's run a comparison on 2,000 shares. So pretty simple, 2,000 shares, $216 each, $432,000 transaction, $67,000 in taxes, $364,000 after tax. All of that goes into the dividends, so a dividend paying stock. So we've got $600,000 plus $364 is $964, giving us a total portfolio of $532,000. And our after tax income for the year is actually going to be a negative. We're going to be down $9,000 because the income generated from the Apple stocks and from the dividend stocks was actually less than the tax we had to pay, the capital gains tax. This may or may not be a bad thing. If you've got low income from the year, if you've just recently retired, maybe it's a good time to have a large capital gains and pay that lesser tax. You might actually be in a lesser tax bracket. And this is why you should always consult a professional. All right, so we run that scenario. So the next one, 3,000 shares, $648,000 transaction, $101,000 in tax, after tax, $546,000. We're starting to get this into a better range. The dividend stocks will be 1.1 million using the proceeds from the Apple share sale and adding it to the initial position. We'd be down $35,000 out of pocket in that first year. Still having a healthy portfolio. I mean, having a portfolio of this size, we're talking about long-term investment. Unless you really need the money, the question is, does it perform better over the long term? And finally, the last one is selling off a huge amount. So selling 4,000 of your 4,627 shares for a total transaction of $864,000, $135,000 in taxes. So your after-tax income $728,000, and this obviously generates the smallest portfolio. But what it does is it brings your annual yield up to 6.48%. So we have this 90% weighting into the dividend stocks and not only 9.3% in Apple. And this is what I've said many, many times before on my channel. Invest primarily in high yield dividend stocks. So that like 6 to 10% is a good yield in 2018. In the past, we've been able to get higher yields than that, but in 2018, a 6 to 10% is a really nice range to be in. So the whole portfolio is generating 6.48%. So although it's less, drastically different from the initial portfolio of 3.47%. So the after-tax income for the year, initial portfolio as it stands, $43,000. Selling off a good chunk of Apple, paying this $135,000. We're generating more dividends. We're still down on the year. So now let's expand this forward. Let's take a look at what this would look like the following years. And obviously, if we're trying to sell Apple stocks, we're not buying any more. So any of the dividends that pay out, we're using the dividend to buy we're using the Apple dividend and the other dividends to buy other dividend stocks, not Apple, because we're trying to reduce the position, not add to it. So we've still got this $1 million. This is based on the fact that the Apple price hasn't changed. Now we'll run the numbers later. What happens if the price goes up? What happens if the price goes down? How did it affect this? But let's actually fill out this chart. Just quickly running through this, we've got Apple, $1 million going to generate the same $10,000 that it was generating before after tax in this year. So next year we'll be in the same boat. The dividend stocks, though, before we're generating 32,000, now they're generating 35,000, slightly more. As we go further down, we can say that after-tax income in 2019 compared to the after-tax income in 2020, the same. But this dividend stocks, we're paying out 62,000, now all of a sudden 66,000. So what you can see from this is that because we've increased our yield, the 6.4%, now annually going forward, we're making a lot more money. So before we were making 45,000, now we're making 78,000. That's a lot of extra dough in our pockets. The expected value, though, our portfolio, although we've made more money, is still lower than it would be had we just kept the Apple shares. Now let's move forward to 2021 and take a look again. In fact, I'm just going to populate the rest of this chart and we'll take a look at all of it. As you can see, the Apple portfolio keeps going up. We've got after-tax income, 45,000, 48,000, 50,000, as we would expect. The Apple position stays the same. We're not buying any new shares, so it keeps paying out, and the money just keeps rolling in. So we're adding both the dividends from the Apple shares and the dividends from the dividend stocks to get the new total for the next year. What eventually happens is that this Apple portfolio starts to perform less. Our total portfolio value all of a sudden is 1.84 million, and the dividends rolling in to 56,000. And that's what's making the difference here. By having this higher dividend yield, 78,000, 82,000, 86,000, 91, and finally 96, that dividend yield actually boosts this up and brings the value up. So it finally surpasses. And in this particular case, using this really basic equation, it took 5 years. Now, this is assuming that Apple price hasn't gone up. Of course, if we change this, if Apple price goes up to 250 bucks, then obviously having a portfolio that has a greater component made up solely of Apple will have a greater result. So $2 million compared to 1.9 million. That said, in this scenario, you've already paid the capital gains way back in 2018 or 19. So depends on where you're looking. I mean, just strictly on a diversification factor, what you don't want to see is the Apple share go way down. If it goes to like $100, then obviously the diversified portfolio is going to well outperform. So if we saw a massive correction, maybe 100's a little aggressive, maybe we do 105, maybe it loses 50% of its value. You see a drop, the portfolio value 1.8 million compared to 1.3 million. I think the big takeaway from here is it's not a bad idea to sell Apple stocks. They could be going up forever and ever. They might not. They might crash back down. We don't know. Having a portfolio that has a massive component made up solely of Apple, I mean, that scares me, and that's why I don't like to invest that way. If this was my portfolio, what I would be doing is I would be selling covered calls and just kind of intermittently selling off those shares, because I could kind of play with a few contracts and make a little bit more money over time. And if the price really jacks up, the shares get sold out from under me. I've made a little bit of extra cash, and it's kind of win-win. I've like made money on the stock and I've made money on the option. If it goes down, I still keep the option premium and I just keep selling it again. So I would just yield boost that way if this was my portfolio. And I don't know, you know, as with many of these scenarios, I probably end up somewhere in the middle of this. Maybe it's better to have a 30% weighting on Apple, and then if it continues to go up, you're still reaping the upside. But if it goes down, you're not getting crushed by the downside. Anyways, that's my thoughts for today. I hope you guys enjoyed that little analysis. If you've got any specific questions, please feel free to make a comment down below. Ask me those questions. I will make a chart like this on any scenario you want. Let's get rich together.